Okay, so this video will be kind of an introduction to the concept, the market shift concept, ICT model, and it'll be kind of covering episode 2, 3, and 4 pretty much. So what we need to know, what we learned basically was buy stops, stops rely above old highs and intermediate highs and above lows. So as you see here, we have buy stops, and then we have buy stops here and here. We have this big move up, and the move up where it takes out liquidity usually equal highs, or at least a lot of highs, liquidity. Then we can anticipate a raid, a buy or sell raid, depending on if we're bullish or bearish. And this can be used to take out previous day's lows or swing lows. Just targeting basically the next high or low on the daily, weekly, or anything. So the way this works is once we get the buy raid, so when we take above highs, once we get the buy raid, we can anticipate that we would get a swing low after we break the high or low, depending on if we're bearish or bullish, what scenario it is. It's opposite, vice versa. So we get a breakout here. Once we get the breakout, we can anticipate a swing low. Here's the swing low. And what we'll wait is for the swing low. Once it's formed, we'll wait for it to get broken. So we wait, and as the candle comes down, this candle right here that breaks this market structure, once it breaks the market structure, that's known as a market shift. And that's because the market has shift directions. And once you see this candle get broken, you'll wait for the next candle to close. And if there's a fair value gap on the candle, below the candle that closed, you will take an entry from there. If there's one a little bit lower, you can probably enter off of the other fair value gap, but there's only one here. So if there's a fair value gap, let's say there was a fair value gap up here, you would wait for price to come up, and as it comes down to the second one, then you buy or sell again, depending what you're looking for. So in this case, there's only one fair value gap. We broke the structure here, which made it a market shift. We broke the swing low. Remember, you need the three candle pattern right here. As we got in, take entry at the 50% or somewhere in here. And then your take profit would be the lows, or as you see right here, we have a imbalance. Price needs to be filled, so we can target here, and that will be our first take profit, and have some profits running below this old low and previous noticeable lows, which here is one. And that's pretty much it. It's pretty much vice versa. If you're looking for the opposite, it would be a sell raid. You'll look for the lows to get swept. And usually ICT stock stays around 8:30 EST, which is 5:30 for us. He is 3 hours ahead. So yeah, that's pretty much it. You want to see a kind of quick retracement after the swing low. You want to see a kind of quick move down, and you want to see a kind of fast reaction into the fair value gap. And your target will definitely be a imbalance or a low. But when you see this strong move to break through, you can anticipate that you would see a swing low, and that it would be a buy rate, and just wait for the swing low or swing high, depending what direction. If you're bearish, you'll wait for buy stops to be taken. If you're bullish, you'll wait for sell stops to be taken before a move higher. And another way you can do this is when you see the low form and you see the high, you can get a Fibonacci, and you can see whether you're in a premium or discounted market. So, for example, from this low to this high, we will be in a we're above the 50. Here's the 50. This is an overbought market, a premium. So this is the 50 right here, sorry. We're in a premium, which means that we can look for sell opportunities above 50 because we're in a premium market. So you see we're in a premium, we can take here, and the fair value gap is below the 50, which means that we're more than likely to come down here because it is, from right here. It is below the 50, so here's perfect take profit area, and here as well. But that's pretty much how it is. When the sell stops get rated, you can do the opposite, and that's pretty much it. And I hope it helps. helps remember. Let's see if I'm missing anything else. You can look for these ideally on a 15-minute. Look for liquidity build up on a 15, and then take entry off a 3-minute. But yeah, the move when it gets broken is known as the market shift. It's not a break in market structure. It's known as a market shift when the swing low and it gets taken out like that. When the sell stops or buy stops are taken and you get a swing low and it gets taken out, that is known as a market shift. And this is the buy raid. This is the market shift. The entry at the fair value gap, profit being the imbalance or the low. Remember, you gotta wait for this candle to close, and then the first one has to break through, and the second one has to close. And wherever, if there's a fair value gap, that's where you take an entry. If there's one higher up, you'll take it from there, or wait for it to get filled and come back down to the second one, and then just take it as soon as it touches it.